One, Joe Gentili from Left Tail Risk Advisors. So today we're going to go through a really important topic for life insurance, and that's the taxation of it, how the tax code treats life insurance. And I'm not really aware of any assets that are treated as favorably in the tax code as life insurance. And this is really one of the most powerful benefits of life insurance, and one of the main reasons why it can play such a powerful role in people's financial lives. So let's go to the general treatment. So, in general, the death benefit of a life insurance policy passes income tax free. So, regardless of how large that death benefit is, it could be a $100 million death benefit. That death benefit is paid tax free to heirs. Within the permanent policy, there's also cash value. For most permanent life insurance design, there's cash value. And that cash value over time, it accumulates interest, the policy compounds over time, and that interest accumulates income tax free or income tax deferred. If the person holds the policy the way it's intended, which is for life, that tax free compounding eventually turns into a income tax free death benefit. So the interest earned within the policy compounds tax free as well. So the way people get money out of a life insurance policy, aside from a death benefit, is they could take withdrawals from the policy. Those withdrawals are tax-free up to basis. So if I have $100,000 of basis in the life insurance policy and my current cash value is $300,000, then that first $100,000 comes out income tax-free. If I want to take out more than that as a withdrawal, then it's taxed at ordinary income rates. What is a more popular way for people to get money out of a life insurance policy, because it avoids the taxation issue, is through policy loans. So you're able to take policy loans for the policy, even into the amount that's a gain, income tax free. So let's assume again, $100,000 in basis. I have 300,000 in total cash value. I could take out most of that cash value as a policy loan, and there's not going to be any income tax consequence for that, as long as I hold the policy until its death benefit and I don't lapse it during my life. That's something to be very careful about. I wish more people knew that up front, which is that if you lapse the policy during lifetime and you have policy loans outstanding, if those policy loans cover gains, then that could be a taxable event. So just always keep in mind, life insurance is meant to be held for life. Most of the benefits that come out of life insurance are going to come from it if you use it as intended, which is to hold it until a death benefit. Next, we go to the estate tax treatment of life insurance. As a general rule, if you're a U.S. citizen or you're taxable or a U.S. resident that's taxable, then the death benefits of a life insurance policy are includable in your state and subject to estate taxes. So that's something important to keep in mind. There's one major exception for that. For people that are not residents of the United States and they're not domiciled here, they're not tax residents of the United States, non-citizens, if they have US life insurance policies, their death benefits are not subject to estate taxes. They get an estate tax-free death benefit, which is very, very powerful benefit for non-US residents that are not domiciled in the United States. For US residents and US citizens, if they have an estate tax issue, the way they typically deal with that with life insurance is have a trust own the life insurance policy. So if they don't have control over the policy and the policy is trust owned, then that is outside of their estate and not subject to estate taxes. So this is something that's very addressable for US citizens and US tax residents with the help of an attorney to draft and maintain appropriate trusts. The two trust structures that are used most frequently with this are ILITs, irrevocable life insurance trusts, and SLATs, spousal lifetime access trusts. So those are the two most popular. There's another way that money can come out of a life insurance policy income tax free, and that's through certain policy riders. And I think the most powerful one is the long-term care rider, or if somebody has a hybrid long-term care policy for which If there is a claim triggered where they're able to get long-term care benefits out of the policy, those benefits are paid income tax free as well. So that's a really powerful way to tap into the policy without incurring taxes as well. There's a couple of exceptions to all of this with regards to the tax treatment. So the first one, and the one that most people have to be most mindful of, is what's called a modified endowment contract, or a MEC. As we've gone over here, there's a lot of really powerful tax benefits with life insurance. And for a period of time in the 1980s, there were abuses with this, where people were using life insurance primarily as a tax shelter for money to be used during lifetime, and they basically were just putting on the smallest amount of life insurance to justify calling it a life insurance contract when it really wasn't. And so Congress cracked down on this, and they want to see you could still have all the benefits of life insurance, but they want to see that it's actually used for life insurance. And the way they handle that is by having a certain ratio of cash value to death benefits that's required. They want to see that the policy doesn't have a super tiny amount of death benefit and it's all cash value. So they just want to see that that ratio exists. And life insurance companies and agents can walk you through to make sure that you're within bounds of that. It's if you violate this, most people that violate it do so intentionally, although it can happen accidentally, but most people do it intentionally because there's still some planning uses for doing that intentionally. But once it happens, it's not reversible. And the way the tax treatment for the policy changes is that the policy still retains the ability to pay out a death benefit income tax free. So that's great. But you now lose the ability to access cash value during life on the same tax preferred way that you can. So for instance, policy loans are no longer income tax free. So that's something that you really want to be mindful of, and the insurance company that you're working with and your agent should be able to guide you through that. The other thing that comes up less frequently for people, but can in certain complex planning situations, is the transfer of a value rule. So life insurance, if it's used as an investment in the following sense, if let's say that I have a life insurance policy, I no longer want it, I sell the life insurance policy to an investor, that is a transfer for value. That investor now has to pay income taxes on any gains they have in the death benefit of the policy. Where this comes up for individuals is sometimes where if they have a trust and they have a pre-existing life insurance contract that they want to put into the trust to avoid estate taxes, or for some other reasons, sometimes the way people will handle that is have the trust buy the policy from the person. That's a complex transaction, absolutely 100% requires guidance from an attorney to do that, because if it's messed up, it could trigger this transfer for value rule. So just want to be cautious of that. The next category is life insurance as it's owned by businesses or as an employee benefit. That's really a separate video. There's a whole host of tax benefits and things to watch out for in that arena. Life insurance does have favorable tax treatment still when it's used for business purposes as an employee benefit, but that's outside of the scope of this video. So overall, this was just a quick walkthrough of how life insurance is taxed. I hope what you can see with this is that the tax treatment of it is very, very favorable if it's used for its intended purpose, which is it's held for life. And there's some things to be mindful of with it to make sure that it stays on course, but with the appropriate guidance, working with the right professionals, that is certainly something that can be accomplished. So as always, I hope this video was useful. And if you have any further questions on this topic, I encourage you to reach out. And if you found this useful, I encourage you to subscribe. So thank you.